Hello children, welcome to the online platform of Sri Gokulam Public School, Guruvayur. Children, we were discussing chapter 9 of your business study. The name of the chapter is Financial Management. In our last class, we have discussed one of the decision, that is dividend decision. We saw that various factors have to be considered while declaring a dividend. Today, we will discuss about the financial decisions. First of all, let us see what is financial decision. Children, financial decision is related to how much finance is to be raised from different long-term sources. It also involves identification of various available sources. So, there are mainly two sources of funds from where the firm can raise the finance. The first source is shareholders fund, which is also known as equity. So in shareholders fund there are three different categories, that is share capital, reserves and surplus. So using these three different sources we can raise the fund, that is a long-term sources. Okay, these two are the long-term sources of raising the fund, and the first one is shareholders fund. Under shareholders fund we have share capital, reserves and surplus. And the other source of raising the fund is from borrowed fund, which is also known as debt, and which include debentures, long-term loans, public deposits. Okay. So these are the two different categories of source of funds. One is borrowing and the other one is shareholders fund. Okay. You are well aware about these two sources of funds in your accountancy also. Now a firm has to decide the proportion of debt and equity. So children, the main decision related to financial decision is deciding the proportion of debt and equity. Okay, it is better to have a combination of debt and equity in your business, and deciding the proportion of debt and equity depends on certain factors. Okay, financing decision is concerned with the decision about how much funds to be raised from debt and how much from equity. So the topic which we are discussing today is financial decision or financing the decision. So in financing the decision, we decide about how much fund should be raised from debt, that is from borrowing, and how much fund to be raised through equity, that is shareholders fund. Okay. So through these two ways, how much fund should be raised, that decision is made in the financing decisions. Now financing decision determines the overall cost of capital and the risk of the enterprise. So it is not simply we are making a decision how much debt and equity we have to raise. We have to make decision about raising the fund by considering the cost of capital as well as the risk involved. Okay, taking these two determinants, we have to make the decision about raising of finance. Now there are factors which affect the financing decision, and this is a very important question. Let us discuss each of the factors which affect the financing decision. So we know that every business firm, they invest different capital, they have different nature of business is different. So their cash flow position is also different. Okay. So our first factor which determine the financing decision is cash flow position of the company. A stronger cash flow position of the company makes debt financing more viable than funding through equity, because it can easily pay interest on debt. Children, you know that the main difference between debt and equity is when debt is like borrowing, isn't it? So whenever you borrow, the money, you have to pay interest on that. Whether it is debentures or bank loan, so any type of borrowings, there is interest payable on that debt. And in case of equity, you have to pay dividend to the shareholders. Okay, so these two situations are there. But in case of debt, if your cash flow position is not so strong, then what will happen? You will not be able to pay the interest on debt promptly. So that will make your business more risk. Okay, it is a risky factor. So if your cash flow position is a stronger one, then you can go for debt financing. That is a more better choice than funding through equity. Okay, because it can easily pay interest on debt. So if your cash flow position is a stronger one, then you can pay the equity, that is interest on debt easily. So it depends on the cash flow position about making a decision whether to go for debt or whether to choose equity. The next factor which help us to make decision regarding selection of debt or equity is the cost. Normally, debt is a cheaper source of finance. Why it is a cheaper source of finance? Because interest on debt is a tax deductible expenses. More debt can be used if cost of debt, that is interest on debt, is low. Suppose interest on debt is less. In that circumstances, you can go for debt as a source of finance. In time when interest on debt is low, you can go select debt as a source of finance. And one more thing which make it attractive is the tax deductible expenses. Interest on debt is a tax deductible expenses. So these two reason makes the debt as a cheaper source of finance. The first one is it is tax deductible, and the second reason is cost of debt or interest on debt. If it is lower, then it is good to select debt as a source of finance. Third reason or third factor which help us to make financing decision is risk. So which one is more risky? Is it a debt or is it a equity? Which one is more risky? It's debt. Okay, debt is a cheaper source of finance, but it is more risky for a business. Why it is risky? Because it is compulsory to pay interest on debt and redeem the principal amount on maturity. See children, debt is like borrowing. So on borrowing, you have to pay interest as well as the amount which you have borrowed, that is the principal amount, you have to redeem it. You have to pay back that amount. So if it is not done in time, then your business will be on risk. Okay. So that factor makes the debt more riskier. Though it is a cheaper source, but it's a risky source. Okay. Therefore, use of more debt increases the financial risk of a business. So while choosing a debt as your source of finance, don't increase, that is, that should be some limit on that source of financing. Okay, because it's a very risky for any type of business. So hence there should be a better combination of both debt and equity in your business. Next is level of fixed operating cost. See children, any type of business, there is a different types of operating costs related to that business. For example, suppose you are operating your business where the building rent you have to pay every month. and you have to pay salary to your staff, and number of staffs are more salaries amount. Okay, and insurance premium you have to pay on your business. So all these cost is known as fixed operating cost, because every month or yearly you have to pay such cost. So suppose if the level of this fixed operating cost is more, then better you don't go for borrowings. Okay, so let's read this. If a business have high fixed operating cost, that is building rent, insurance premium, salary, these are the examples of fixed operating cost. If this is high, then that is high operating or business risk is there. It can assume lower financial risk. Therefore, lower debt financing is better in this situation. So if you are having high level of fixed operating costs, then better you can offer lower debt financing. On the other hand, if more of debt financing is preferred, if the level of fixed operating cost is less. So if your fixed operating cost, that is rent, insurance, salary, this is less, then you can go for borrowings or debt financing. Otherwise, better you keep a limit on that. Then the fifth factor which determines your debt and equity source of finance selection is floatation cost. Now, what is this floatation cost? Cost of raising fund is called floatation cost. Children, for raising the fund, some cost is involved. For example, if you are raising the fund through issuing of equity shares, then you have to advertise that, advertisement of such issue of share has to be made. At the same time, printing of prospectus. These all are cost involving factors. So cost of raising fund is known as floatation cost. Issuing equity shares involve cost of advertising, printing prospectus, etc. Getting a loan from a financial institution may not cost so much. So you have to make a choice. See, floatation cost, if it is high, which is attached with equity shares, if it is high, better you go for borrowings, that is taking a loan. Okay, so many a time firm, they go for a floatation cost before making a decision for financing or borrowing, before making a financing decisions. Okay, the next point is control consideration. Debt normally does not cause a dilution of control, while issue of equity shares may reduce management control over the business. See children, issuing shares means what? You are making, or your company is making, outsiders or shareholders the owner of the company for the shares held by them. How much shares they are holding in this company, for that part of shares they become the owner of the company. That means you are losing, there is a loss of control of your business. Okay, so you are giving the control of the business, you are sharing the control of the business with the shareholders. So there is a dilution of control. Okay, so it is also a factor that if you don't want your control, business control, management of your business control in some other outsiders, then better you go for debt. Okay, so in debt there is no case of dilution of control. So in this case also you can, the choice can be made. The next point is seventh point, that is state of the capital market. During the period when stock market is rising, that is the period of boom. Rising means the share or the stock market is showing a good trend, okay, high trend. So in such case, the market will be known as boom period or bullish period. You can see in this picture a bull which is having a thorn, and it is pointed upward. This upward pointed tron is representing rising of market. Okay, so that means the profit in this situation, if you are investing the shares in equity shares, then it is a case of when your stock market will be rising. Okay, so more people will invest in equity in that cases. So in the boom period or bullish period, the market will rise, so you can invest in equity share in that period. Okay, and if it is a depression of capital market, depression means bearish phase, bear. Okay, so depression is represented by bearish phase, may make equity issue difficult for a company. So in that case, don't go for issuing of equity shares. Okay, better you go for borrowings. So in these two state of capital market also, sometimes you may have to make decision regarding opting of source of fund, that is whether to go with equity shares or whether to go with a debt. Okay, so these are the 7 factors which will help you to determine or make a decision of, which is known as financing decisions. Okay, so actually financing decision is making a decision of which source of finance should be opted, or what should be the combination of equity and debt in your business. So that is a financing decision. So when you make decision, these 7 factors have to be considered. See children, this is a very important question, because the maximum marks of 6 mark question which is asked is from this chapter. So these factors, the financing decision, investing decision, and dividend decisions, capital structure, these all are very important from exams point of view and that 6 marks point of view. So you have to read your textbook covering this point very carefully and mark the important lines whenever that is while going through this lecture class, whatever highlight or points which is focused on, and that you have to underline while you are reading the text. Attend the test paper, attach, and we will meet in our next session with one more decision, that is investment decision. So till then, goodbye, take care.